Welcome to part 2 of the Hands-on 5 tutorial video. First, we will go through cash inflows and outflows of our results. And we will go to cash inflows and outflows, which we'll click here. You'll see this page and there's another table. So the table shows all sources of cash coming into the project account in a certain year and cash flowing out as expenses. So clicking on this button, the table can be exported to Excel as well. Here we can see that the top part shows inflows. So if we move this here, the top part shows inflows by sources. And during the construction years, the sources of cash include equity, loans, and the standby facility. So you can see equity, loans, and standby facility. The company borrows from Export Credit Agency and uses as well as a project loan. However, they are added up and reported as loans drawdowns. And this money will be spent to pay the bill of the plant construction. There is a shortage of funds during the construction years, therefore the model withdraws from the standby facility, which you can see here, to meet the expenses. From 2017, we can see that the only cash inflows are the revenues. So from 2017 onwards, you can see that this is the only thing that comes in. Between 2021 and 2029, however, the standby facility is used again to meet a shortfall, and we can see this here. So if we move this back to find where the standby facility is, we can see that from 2021 to 2029 that it is being used again. Now let's look at the lower part, which presents the cash outflows. So we'll go back and move down to see the outflows. And we see that between 2013 and 2016, major expenses are construction related. So if we go up to look at the top row between 2013 and 2016, which are these columns here, you can see that major expenses are construction related. So other expenses are interest payments and loan repayments. And from 2017, outflows include operating expenses, such as fuel and financing expenses, including interest payments and loan repayments. In the last row, cash outflows for VAT payments and cash inflows of VAT reimbursements are reported, which you can see here. So VAT repayment is reported in negative terms as minus 219.876 million ringgit over here, which is used to repay the standby facility that paid the VAT. From the year 2033 onwards, large amounts of cash are deposited as short-term deposits, as shown in the topmost row. So if we go up, and if we go to 2033, we see that there is a value. However, this is not a good use of cash, as a short-term deposit provides a low interest. Therefore, we can conclude that this is not a good financial plan. So a better financial plan could have been developed by, for example, repaying equity or releasing more money as dividends to shareholders. Nice, so now we know how to interpret cash inflows and outflows, and we will move on to the next one, which is the balance sheet. So note that you can also move around with this drop-down menu here. So the balance sheet provides a snapshot of the financial health of a project or company by reporting the sum over the years of what it owns and what it owes at a certain point of time. So what a company owns is called assets, reported in the upper half of the table. So if we move to left, the first half is assets. And what it owes is called liabilities, which is reported in the second half, so over here. And you can see that it is being differentiated by this blue shaded region. So again, if you click on this button, you can export this to Excel. So let's discuss the asset portion first. So when construction is completed, the asset value is reported as a total construction value, which is 2,748 million. Receivables are short-term assets, which would be in cash soon. So in this case, this is the VAT, which has been paid during the construction and will be refunded in the year the plant starts selling electricity. So the short-term deposit, which is this row here, starts accumulating after the year 2032. And you can see this when we start moving to the right. So like we said, in the year 2032, which is here, it starts accumulating. So we'll now investigate the second half, which is the liability portion. So investors' equity is liability to the project company, which is reported in the first row. Cumulative retained earnings reported in the operating account are transferred to the balance sheet and are reported under the headings retained earnings. Outstanding loans from export credits and other sources, net of principal paid in that year, are reported under net loans outstanding, which is here. And current maturity includes amounts due next year, which is this row here. So for example, the accumulated standby facility plus the loan amount due next year. And we are now done with the balance sheet. We will now move on to the next results, which is shareholders return in local currency. So we can see that at the top, the NPV value and the IRR value is reported here. So we can see that the NPV is positive and the IRR is 13.23%. Both are good, and so the project is attractive for investors. We can also see that equity was injected for 4 years, starting from the year 2013. After 2016, no equity was injected. So we can see that values are only presented from 2013 to 2016. Therefore, equity outstanding in the year 2017 and onwards is 650 million. The dividends in the year 2021, so dividends is this row here, in 2021 is 62.3 million ringgit, and equity is 650 million ringgit. The return on equity is 62.3 divided by 650, which is 9.58%. And next year, the dividends increases to 91.5 million ringgit. However, outstanding equity remains the same at 650 million, which we have seen here. Therefore, the return on equity is 14.1%. And that's it. We have now interpreted the shareholders return sheet. On to the next one, which is financial ratios. So a power project has many stakeholders, including the owners, investors, lenders, government, and regulators. FINPLAN calculates financial ratios, which will be interesting for various stakeholders. And we will now have a look at these ratios. So we'll see that there's another table. And these ratios determine the financial viability of the project from the viewpoint of different stakeholders. So again, we can click on the top right to download this table to Excel. We will quickly explain 3 ratios, which is the leverage, exchange risk, and debt service coverage, which is down here. The meaning behind these ratios is explained in the lectures, so I will quickly go through this in this video. FINPLAN has a default value for each of these ratios and judges the computed value from the project relative to that. So if it is less than the default value, then it reports it as PB, which means problem, or otherwise, if it is okay, then it will say okay, like this. So I won't go into too much detail about leverage and the other financial ratios, as you can find more information in the hands-on. But in short, if we assume a debt equity ratio for this project of 75 to 25, then we can see from the table that it is not complied between the years 2014 and 18. You can see that it is a PB. Therefore, this plan may not be acceptable. So more equity needs to be injected during the construction years. This will, however, influence many other financial aspects of the project, for example, the NPV or IRR. If we move down to exchange risks, we can also see, well, it is clear that the financial plan of our project is not acceptable to the lender, as the exchange risk ratio is less than 1 in 2017, so 2017 is here, and 1 thereafter. So it can be improved by increasing the revenues, that means the electricity price, or replacing some foreign loans or bonds with debt in local currency. So going to debt service coverage. Lenders monitor this indicator during the loan repayment period. So if it is less than 1.3, then the modeler should consider if adjustments are required. For example, an option is to increase the price or inject new equity. So the debt service coverage ratio, as shown here, and we can see, if we move up, we can see the years. So if we move on to the right hand side, can see that the current financial plan of the coal power plant project may not be acceptable to lenders, as it is less than 1.3. And we're looking at this from the threshold of 2017 to 2020. So 2017 is here, 2018, 2019, 2020, 2021, 2022. They're all less than 1.3. So the current financial plan of the coal power project is not acceptable to the lenders. And we have now interpreted the financial ratios results. We will not go through the project finance analysis in this video, however, you can find more information on this in the lecture slides. So now we have interpreted our results from our hands-on case study. However, if you're not getting the same results as shown in the above screenshots, you may want to download a completed FINPLAN case study for this exercise and restore it, where you can compare the values one by one. So to do this, we will have to go to the hands-on. So if we go to our hands-on 5 here, and if we go down to activity 4, you will find a link where you can download a file. So we will click on this link, which will take us to a Dropbox page, and we will click on this download button to download the completed coal demo file, and we will get it as a zip file, which you can see here. So in FINPLAN, we will click on Manage Case Studies, and in this corner here, you'll see Restore Case Study. So to restore a case study, we will have to click on this Select Case button, click on the file that we just downloaded, so completed coal demo. So I've already downloaded it before, which is why this says completed coal demo 1, because I have already downloaded it before, and this is another copy, but you should have one that says completed coal demo. Click on open and click on restore. And you'll have this completed coal demo file in your FINPLAN software now, which is the same as the hands-on case study, but with the completed values and the correct values. So if you ever want to go through the values, the input values, and compare it one by one in case you think you did a mistake, this is how you should do it. And well done, you now know how to restore case study files. And we have now finished our Malaysian coal power plant case study. In hands-on 6, we will look into a new case study, so we will look into a combined cycle gas turbine case study. And in hands-on 7, you will look at another case study which will include a nuclear power plant.